Well, first of all, we've received an unprecedented warning from the Deputy Governor of the Reserve Bank of Australia. And he said that there is a real possibility that at the time we have higher interest rates, we could see a meltdown in the global debt markets because so many people have punted that lower interest rates are going to keep going, and that's via the derivatives market. And he's issued a warning. And the ASX, via the CEO's KGB interview, said that the very low interest rates that we're looking at now are like a drug. And you don't even, at this stage, you don't even realise you're taking it. And one day, this will blow up on us. So we've had these two clear warnings from very senior people that we're into dangerous areas. Now, we've just seen quite a lot of turbulence in the equity market, the stock market, and we've seen there a display of many of the forces that the Reserve Bank and the Stock Exchange have warned us might one day affect the debt market.
So what kind of forces are we talking about here?
Well, first of all, the biggest part of both the debt and the equity markets is derivatives. And people take call options, they underwrite particular securities, there's a whole raft of things. And when you get a big fall in a marketplace, a lot of these positions get liquidated. And similarly, people have bought shares on margin, and if falls take place, they often get sold out. And so we have these forces. Now, what we've just seen recently in equity markets, that we saw these forces coming to play, and we saw big falls on Wall Street in particular, but also in Australia as well. And we saw these forces in action. We saw people being sold out on their margin calls. We saw the derivatives being liquidated. But so far, we've seen buyers come in to stabilise the market. What the Reserve Bank is warning us about is that, look, if in the debt markets, if we have a big enough fall, it will keep going. You won't be able to support it, as we've just seen. And one more point. Remember that the fall in the equity market this time round has been accompanied by a rise in US bonds. So we're not looking at anything like the Reserve Bank scenario. Merely we're just watching the forces that they've isolated play in the equity market. And it's been a nasty experience, but not a catastrophic experience. And we've seen buyers come in. And of course, as I said, the Reserve Bank is warning that if there was a debt meltdown on higher interest rates, those buyers might not support the market.
So with these RBA comments, should we be taking them at face value, or is this a case of them trying to put some messaging out and maybe doing a little bit of double speak?
There's no doubt that by warning of this situation, they may help prevent it. Because institutions who might be inclined to have a bit of a punt, some of the superannuation funds we've got in Australia have a little bit of a punt on the derivatives market and go at risk, because there's been good dollars to make on it. Seeing that Reserve Bank warning, they'll be more cautious. Maybe it'll spread to the rest of the world. I don't know. But so we've had a warning from them. But look, don't have any doubt that if we see too fast a rise in interest rates, there is great danger that all these people that have punted on these low rates will burn, because, for example, if the American bond rate was to increase, there'd be a huge fall in bond prices. Now, all the people that have leveraged to buy these bonds would lose a fortune. Similarly, people have leveraged at very low interest rates and invested in emerging countries. And suddenly all the money starts coming back from those emerging countries. The people who have leveraged to do that will start to fall to bits, and they'll sell other things. So it's we've been taking, in the ASX's words, we've been taking a drug. Getting off that drug, and the drug, of course, is very, very low interest rates. Getting off that drug is a dangerous exercise. We've got to do it sometime.
Sounds like there's plenty to keep an eye on in the coming months. Robert Gottliebsen, thanks very much.
Thank you.